Bond yields rising along with stocks today on that CPI report. Let's get over to Rick Santelli at the CBOE for more. Hi, Rick. Good to see you.
Yes, it's great to be on again with a very special guest. We have Jerome Schneider, Managing Director of the short end of PIMCO. Jerome, welcome. Well, I'll start out with CPI this morning. I brought it out at 8:30 Eastern. It definitely was on the warm side, and it really does underscore how tricky it is, what we call the last mile, meaning as the Fed gets close to their first ease, how does today's CPI affect that decision-making process?
Yeah, well, at PIMCO, we don't necessarily think it affects the situation for June. That probably still remains in play. But the focus on the last mile, as we term it at PIMCO, is really a focal point for investors and the Fed as well. We see inflation moving from a goods sector to obviously concerns about rent to concerns about wage pressures longer term. And a lot of these things are in flux, and ultimately the equation doesn't necessarily mean that you're going to get back to that 2% threshold for the Fed as quickly as suggested. So while the Fed might ultimately react to this downward trend in June, the longer-term trajectory of rates might somewhat be in question at this point in time. And so a more muted view of how the Fed thinks about it is going to probably be in the cards for the near term for 2024. The real question ultimately comes is what happens in 2025 as you get a confluence of wage pressures, earnings coming from the corporate sector.
Now, let me stop you right there. When it comes to wage pressures, we all know, as we've seen strikes, and there's going to be more strikes. Longshoremen are talking about it. These things are going up. But there's certain aspects of the economy where there's sticky inflation that no matter what the Fed does with interest rates, it's not going to make a lot of difference.
Well, I think ultimately focusing on the wage pressures is important. When you dissect it, there's going to be some technical industries which will contribute to the upward momentum in wage pressures, even though you might have the broad-based service sector of employment continue to stabilize out of the COVID environment. More importantly, though, when we think about these opportunity sets, it means we're in a period of stickier inflation, growth, which is somewhat still lower than expected, especially compared to 2023, and a multitude of events, including geopolitical, that the Fed may or may not necessarily take into account.
It sounds a bit stagflationary, but embedded in that very inverted yield curve, that two-year note, as they start to ease, could afford some opportunities. Your thoughts?
Yeah, we ultimately believe that there are some opportunities through the dispersion, through the active management in this regard, and really focus on the opportunity for being defensive, lower volatility in fixed income, finding opportunities within that 0 to 5 year sector, having some income and some diversification along the way, even though corporate bonds might be relatively tight, diversify away from that. So from that, we want to really remind investors, simply don't be late for dinner. And what we mean by that is move out of the money market funds, out a little bit of interest rate exposure to help counteract some of the forthcoming yield declines, which ultimately means price appreciation in bonds.
So don't try to overly time it. There's going to be a handoff between money markets with juicy rates and juicy rates that still remain in two-year maturities. Okay, and finally, let's do one more pass. When I look at what's going on with the Fed, my big issue remains supply. Supply is the outlier that could affect longer-term rates. Very quickly, do you think that we should be paying extraordinary close attention to these auctions the way we have on the long end?
Today is a case in point where you want to ultimately understand where the demand side is coming from. And that demand side is really a function of term premium, inflation expectations, supply forthcoming. That's a longer term. It's a secular view over the next 3 to 5 years. And ultimately, investors are going to demand a certain amount of premium that may not necessarily be there today. We focus at PIMCO on being at the intermediate to shorter part of the yield curve as the opportunity set right now that might ultimately change as the yield curve changes as we get to more normalized pricing policies from the Fed.